Every day, prices go up while paychecks stay the same. Groceries cost more, gas prices keep rising, and saving money feels harder than ever. But here's something most people don't realize. You don't need a lot of money to start growing your money. In fact, with just $50 a week, that's $7 a day, you can invest in 3 dividend stocks that quietly build wealth in the background. In this video, I'll show you and John 3 dividend stocks that will surpass your full-time job, and how these stocks pay you regularly. I'll show you stocks that pay over $5,000 and $7,000 in monthly dividend income. And in the end, I'll show you a stock that has the potential to reach an over $2 million valuation and pay over $9,000 in monthly dividend income. So my goal in this video is simple: help you and John build a reliable, stress-free source of passive income. Not just an extra couple of bucks, but enough to surpass your full-time job. For some, that might mean covering the basics, $5,000 per month to handle rent, groceries, and bills so you're no longer dependent on a paycheck. For others, it's about hitting $7,000 to $10,000 per month, where you can travel, invest in bigger opportunities, or just enjoy life on your own terms. The best part? You don't need to be rich to start. The right dividend stocks can build wealth for you in the background, no matter your starting point. Up next, I'll show you my 3 favorite dividend stocks to surpass a full-time job, ranked from $5,000 in monthly dividend income all the way up to $9,000 per month in dividends. And to kick things off, let's talk about a stock that turns real estate into steady, long-term income. At number 3, we have NetEase with the ticker symbol NTES. While it might not be the first name that comes to mind when talking about dividend growth, this tech giant is becoming a powerhouse for investors focused on capital appreciation and passive income. NetEase is known for its diverse portfolio of successful online games, including Fantasy Westward Journey and Identity V, as well as its partnerships with international gaming companies like Blizzard Entertainment. The strong presence in gaming has pushed the company's revenue and net income growth. Over the past 5 years, NetEase has experienced an average annual revenue growth of 15.66%, with even higher figures in some individual years. On the dividend front, NetEase offers a forward dividend yield of 2.36%, which is a compelling factor for dividend-seeking investors. Over the past 3 years, the company has managed to increase its dividend by 43.64%. Despite its relatively low payout ratio of just 7.22%, the company's commitment to dividend growth signals its financial stability and promising future for shareholders. Looking at its stock performance, the stock has shown a strong growth trajectory with a 5-year return of 68.35% and a 10-year return of 424.37%. This long-term upward trend shows the company's potential for future growth, especially as China's online entertainment market continues to expand. As for the projection, it has a dividend yield of 2.36%, backed by a strong average 10-year dividend growth rate of 17.29%. And to top it off, it also has an average 10-year share price appreciation of 16.02%. So based on these metrics, let's say John invests $50 a week into this stock. Here's how it looks. After 1 year, the investment would accumulate to around $2,600. In just 5 years, this investment would grow to $18,774. Keep this up for 10 years, and the total portfolio will be valued at $62,882. After 20 years, this investment would reach $417,729. And if John stays invested for 30 years, the total portfolio value would soar to $2,491,853, with yearly dividend income of $70,931. That's about $5,911 per month. When you combine reinvested dividends and capital appreciation, the total value added to this portfolio is $2,413,853. So for anyone earning around $5,000 per month from their job, this stock has the potential to completely replace that income in the long run. These are very good returns, but there are better options to come, and in the end, I will show you a stock that maintains the same portfolio valuation but pays double the monthly dividend income. At number 2, we have Lowe's Companies with the ticker symbol LOW. Low. Lowe's is a staple in the home improvement retail sector, providing everything from tools to appliances, and it competes directly with giants like Home Depot. Founded in 1946 and headquartered in Mooresville, North Carolina, Lowe's has grown into one of the largest retailers in its industry. With a market capitalization of $144.83 billion, it employs over 226,000 people and serves millions of customers each year across the U.S. and Canada. When considering dividend stocks that could potentially replace a full-time job income, Lowe's stands out for its strong fundamentals, consistent dividend growth, and impressive capital appreciation over time. Lowe's currently offers a dividend yield of 1.79% with a dividend growth rate of 17.99% over the past 5 years. The stock also boasts an average annual return of 13.78% in share price growth. These figures show Lowe's ability to provide both income and capital appreciation to its investors. In addition, Lowe's payout ratio is 38.07%, which is sustainable and shows the company's commitment to rewarding shareholders while maintaining financial flexibility. If you're wondering where I get all this data from, let me tell you about our channel's official partner, Seeking Alpha. It's my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive data-based stock rankings have been an absolute game changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%. So, definitely check them out in the description. They've promised to give a 20% discount on premium membership with a 7-day free trial and a 10% discount on alpha picks to anyone in our community who join using the link from the video description. Okay, back to Lowe's. Let's break down the $50 plan with this home improvement retailer. In 5 years, the investment would grow to $13,000. After 10 years, the investment value would be around $55,662. As we move to the 20-year mark, the investment would grow to around $327,828. In 30 years, Lowe's would become a true wealth generator. It'll be valued at $1,889,169, paying $93,284 in annual dividends, which equates to about $7,774 in monthly dividend income. The total value added to your portfolio will be $1,811,169, with $1,334,721 coming from capital appreciation and $476,448 from reinvested dividends. And now finally at number 1 and topping our list is Morgan Stanley with the ticker symbol MS. Morgan Stanley is one of the world's most recognizable names in investment banking and financial services. Founded in 1935, the company has grown into a global powerhouse, managing billions in assets, underwriting massive deals, and helping both institutional and retail investors grow their wealth. While many associate Morgan Stanley with Wall Street, the firm has expanded beyond traditional investment banking, making strategic acquisitions such as E*TRADE and Eaton Vance to strengthen its wealth management and asset management divisions. Unlike consumer-facing banks that rely heavily on lending and deposits, Morgan Stanley's business thrives on advisory services, capital markets, and wealth management. These divisions generate stable revenue streams, helping the company perform well even in economic downturns. This balance between riskier investment banking activities and the more stable recurring revenue from wealth management makes Morgan Stanley a strong long-term investment option. Morgan Stanley is also a dividend-paying stock that has consistently rewarded investors over the years. In fact, it's been paying dividends for 27 consecutive years. While banks don't always come to mind when thinking of dividend stocks, Morgan Stanley has built a strong case for itself by delivering solid capital appreciation, steady dividend growth, and shareholder-friendly policies, including regular stock buybacks. It has a current dividend yield of 2.7%, backed by an even stronger dividend growth rate of 16.89%, and an average share price appreciation of 14.01%. Based on these metrics, if you invest $50 a week into this stock, here's how it looks. After just 1 year, you would have accumulated $2,600. In 5 years, that investment would be valued at $18,215. Fast forward to 10 years, and the portfolio would grow to $58,846, benefiting from both share price growth and reinvested dividends. But the real power of compounding happens in the long term. After 20 years, this portfolio would rise to $372,537. And if John stays invested for 30 years, the portfolio would reach a solid $2,267,735, with $115,955 in yearly dividends, which breaks down to about $9,663 per month. When you combine capital appreciation and reinvested dividends, the total value added to this portfolio is a mind-blowing $2,189,735. Of this, $1,579,236 come from stock appreciation, while $610,500 come from reinvested dividends. This marks Morgan Stanley as one of the best options, but should you go all in on this stock? Well, the answer is no. You should never go all in on an individual stock. So the next best option is to create a portfolio of these 3 stocks. For the portfolio, you'll have separate investing metrics. To calculate the average current dividend yield across the 3 stocks, add up their yields and divide by 3. For example, we have NetEase at 2.36%, Lowe's at 1.79%, and Morgan Stanley at 2.7%. So the calculation is 2.36% plus 1.79% plus 2.7% divided by 3, which gives us an average of 6.85% divided by 3, or approximately 2.28%. You can apply the same method of averaging to calculate the dividend growth and share price appreciation for the portfolio. So if you combine these stocks, you'll have a portfolio with a current dividend yield of 2.28% and a strong average dividend growth rate of 17.39%. It'll also have an average share price appreciation of 14.6%. Based on these metrics, after 5 years, your portfolio would grow to $18,263. By year 10, the portfolio reaches $59,068, benefiting from both share price growth and reinvested dividends. After 20 years, the portfolio would rise to $370,964, and after 30 years, it would be valued at $2,193,258. At this point, the investor would be receiving $92,709 annually in dividends, translating to about $7,726 per month. When combining capital appreciation and reinvested dividends, the total value added to this portfolio will be $2,115,258. Of this, $1,619,463 comes from stock appreciation, while $495,795 comes from the reinvested dividends. Want more in dividends? Click the video on the screen to find out how to earn over $20,000 in monthly dividend income with the same investment amount.